Stock, bond and currency markets continue to ponder what is going to happen to the UK economy, not least in the context of the coming budget this autumn. Soggy GDP growth numbers, the Labour rebellion on welfare payments and the relatively slow rate of decline in UK interest rates all raise questions as to whether the Chancellor of the Exchequer, Rachel Reeves, will be forced to reassess her and her party's plans for spending and taxation. Both issues matter on a direct level for investors' portfolios and their wider personal finances too. It's too early to judge whether the Chancellor can stoke growth and meet her own fiscal rules on government borrowing. In the case of the latter, the aim is to match day-to-day spending with income from taxes and reduce the aggregate deficit as a percentage of GDP on a 5-year view. After barely a year in office, it's too early to say whether she and the Labour government can succeed, but the strain could already be telling, judging by the Chancellor's tearful appearances in the House of Commons amid July's backbench rebellion over welfare reforms. The UK government bond market doesn't seem convinced either, given how the yield on the benchmark 10-year gilt is higher than it was at the time of Labour's general election victory in July 2024, even though the Bank of England base rate's down over the same period. Investors may ultimately look to their portfolios to gauge the effect of Chancellor Reeves' policies, and in this respect she's off to a decent start, despite President Trump's tariffs, war in the Middle East and those turgid UK economic growth figures. The Chancellor's Leeds reforms package generally drew praise, albeit of the lukewarm variety, and the FTSE All-Shares up by some 13% since Labour took office last summer, a gain that's outpaced inflation. Rachel Reeves is actually the 21st Chancellor of the Exchequer since the inception of the FTSE All-Share Index in 1962, and the 6th member of the Labour Party to hold the post during that period. She's already outlasted 4 of her predecessors, all of whom are Conservatives, the ill-fated Ian MacLeod, as well as Kwasi Kwarteng, Nadeem Zahawi and Sajid Javid. Stability is always welcomed, and the Chancellor's first year in office represents a steady one for equity investors, despite those signs of unrest in the bond market and on the backbenches. The FTSE All-Share rose by 6.7% in nominal terms. That worked out at 2.3% in real post-inflation terms in the 12 months after Labour's victory in the 2024 general election. Cooling inflation is helping here, and the rate of change in prices could yet define Reeves' term as Chancellor, especially if external events take a hand. A stronger pound, weaker oil and gas prices and thus a lower energy price gap and softer global trade could take some of the steam out of inflation and even cut the Chancellor and the Bank of England a break. You never know. An easing in the rate of inflation and thus perhaps lower interest rates could also yet benefit investors' UK equity exposure, although the opposite could apply too, given variables such as tariffs, wage growth and ongoing unrest in the Middle East, and what they could in turn mean for energy prices. The gap between nominal and real inflation-adjusted returns from the FTSE All-Share Index under some Chancellors is truly glaring, and this is company that the current incumbent of living in Downing Street may not entirely wish to keep. Inflation had a withering effect upon investors' returns from the stock market under Labour's Denis Healey's chancellorship in the mid to late 1970s, even if his supporters would argue his record was tarnished by the need to tackle the mess left behind by the crack-up barber boom and oil price spike of the early 70s. Inflation also chewed up the nominal gains made by the FTSE All-Share under the Tory Chancellor Sir Geoffrey Howe and the aforementioned Tony Barber, who were in office between 1979 and 1983 and 1970 and 1974 respectively. Not all of the inflation that tore through the British economy in 1973-4 could be laid at the door of Mr Barber's policies, as the 1973 oil price shock had a huge amount to do with it. And that highlights the importance of factors which are beyond the control of any Chancellor, no matter how diligent or skilled. Alistair Darling could hardly have expected to inherit the great financial crisis which prompted a deep recession and a wicked bear stock market. Norman Lamont inherited British membership of the exchange rate mechanism, fought to defend the pound and a policy in which he didn't really believe, and ultimately oversaw a devaluation of sterling which actually helped the FTSE All-Share to rally. Mr Rishi Sunak had to contend with the COVID-19 pandemic and the worst recession for 3 centuries, so maybe he got the worst hand of all. Even so, investors looking at the world through the narrow perspective of their portfolios will be wanting Rachel Reeves to think back to Barber and Healey. The Chancellor's desire for growth is totally understandable, especially as rapid nominal GDP growth could help to shrink the debt to GDP ratio, providing borrowing and base rates are kept under control. But that's a big if, and should the backbench rebellion and welfare reforms be any sort of guide? Failure to rein in spending could raise fears of fiscal profligacy and, in a worst case, a situation where suppressed interest rates and even money printing come into play as tools to make the aggregate debt manageable. Further increases in the 10-year gilt yield and perhaps the gold price may give investors a valuable steer as to the likelihood of any such scenario. Hope all of you and your families are well. Thank you for watching, and I look forward to seeing you again next time.